You are not afraid of death. You are afraid of the hours after it starts. The hospital calls, the bills stack up, and the person who pays them vanishes. And here is the part nobody wants to say out loud. Insurance companies do not make money by caring. They make money by pricing uncertainty in a way that usually protects them and only protects you under narrow conditions. This is not financial advice. This is financial education, because in 2026, the most expensive mistake most families make is the same mistake over and over. They buy protection the way they buy a phone plan, then act shocked when the fine print behaves like fine print. If you feel like your life is getting squeezed by AI layoffs, rent that climbs faster than your raise, and inflation that kept eating your purchasing power even after the headlines calmed down, you are not imagining things. The system is moving money upward. It always has. And insurance is one of the cleanest, most socially acceptable ways to do it while wearing a halo. So today you are going to hear the ugly truth about how insurance sales really works, why many people never collect when they think they will, and why the same logic that makes the wealthy buy protection also makes the rest of us get sold products we do not need. And yes, I will go through how I would structure protection like an adult who understands odds, cash flow, and leverage. Not a fantasy, not a brochure, the mechanism. But first, let's talk about fear, because fear is the product, not the policy. There is a reason the pitch always starts the same way. The agent says, "What if you die? What if you get sick? What if your family is stuck?" And you nod, because the fear is real. Nobody wants to picture the worst day. Now zoom in on the business model. When you buy insurance, you are not just buying money in an emergency, you are buying a controlled disagreement between you and a contract. The company is betting on the statistical likelihood that you will pay premiums for years and then never trigger the biggest payouts. That is why their profits can be so stable, even when the economy gets messy. In 2026, that model matters even more because uncertainty is accelerating. AI is not just threatening jobs, it is turning careers into shorter contracts. Whole categories of middle-income work are shrinking faster than retraining can keep up. You might still have the same job title, but the work is being automated, and the bargaining power is gone. At the same time, central banks have raised and held rates through multiple cycles, so borrowing costs stay high and budgets stay tight. When money gets tight, families cut corners. They cut savings, they delay care, and they hope the next year is better. Then they meet an insurance agent at the exact moment they are psychologically weakest. The agent shows up with reassurance. The company shows up with language that feels comforting. And you sign. But here is the trap nobody calls a trap. You can be honest, pay on time, and still get denied because you did not buy the right coverage, or you did not disclose correctly, or the scenario you imagined is not the scenario your policy actually pays for. And that brings us to the first cliffhanger. The reason insurance denials are so common is not usually because every agent is a villain. It is because the process is designed to reward sales volume, and it punishes complexity. Let's start with how insurance sales really grows, because it is not built like a normal profession where you get better by helping customers. It is built like a recruitment funnel dressed up as empathy. Picture a sales team leader at a major insurance firm sitting down with their manager. The manager does not care about your grandparents' heart health. The manager cares about numbers that can be tracked weekly. In a business like this, the fastest way to increase premiums is not to invent new clients. It is to recruit more salespeople who will produce more policies. So what happens? New agents do not primarily serve clients. They are trained to find more people who can buy. And the easiest people to sell to are the ones already emotionally close to the agent: friends, family, coworkers, neighbors, anyone where the social relationship makes no one want to say no. You have probably seen it. Someone you know suddenly gets a new title, suddenly posts about financial responsibility, suddenly calls you about a quick check-in. They talk like they are doing you a favor. They use gratitude language. They say you remind them of someone they want to help, and because you are human, you comply. You buy. You do it to protect the relationship, not to optimize the policy. Now here is where the strategy becomes darker. The recruitment system is optimized for short tenure. A high proportion of agents churn quickly. They do not last because selling is hard when your prospects are rational and your value proposition gets judged against the fine print. But if the first pipeline of potential customers is mostly your own social graph, then after the warm leads are used up, your income collapses unless you keep recruiting. A friend of mine once knew a senior manager at a large insurance brokerage network. The manager told him a number that sounded unbelievable until you understand incentives. In 3 years, out of more than 300 recruited agents, only 2 stayed long enough to reach high-level productivity. The rest disappeared after their friends and family stopped buying. The 2 who remained were not magically more ethical. They were better at volume, better at conversion, better at expanding beyond their own circle. So, when you hear the pitch that insurance is a service, remember this: For many agents, their real product is not your protection. Their real product is the policy premium, and their real growth is the number of new people they can approach. Pattern interrupt. Think about 2026 for a second. The creators on social media are also recruiting. They recruit attention, they recruit subscribers, they recruit brand partnerships. Most people who start content earn nothing. Most get paid by the platform only if they become a reliable advertiser for someone else's product. Insurance is similar, but with higher stakes and more bureaucracy. Your life event becomes someone else's commission cycle. Your fear becomes their funnel. And if you ever wondered why the same family member who sells insurance is also the family member who pressures you to sign quickly, it is because urgency reduces your ability to read, and reduced reading reduces your chances of noticing that the policy is not doing what you think it does. Now, you may be thinking, fine, some agents are pushy, but what about the big picture? Why would billionaires buy insurance if it was such a bad deal? Because insurance is not inherently evil. It is inherently conditional. It is a tool. Tools are not moral. They are mechanical. The wealthy buy insurance because they have assets, complex liabilities, and multi-year planning. For them, insurance is part of capital preservation. It is a risk transfer contract that can be rational. They can afford the premiums, they can tolerate restrictions, and they understand that payouts depend on conditions, definitions, and evidence. Your average person buys insurance like it is a promise instead of a contract. You treat it like a safety net. The company treats it like a risk bet. Now connect that to leverage. Insurance is effectively financial leverage on improbable events. You pay small amounts over time to gain a large payout if a rare disaster occurs. If disaster never happens, you lose the premiums. If it happens, you might win enough to protect the family balance sheet. The problem is not that insurance uses leverage. The problem is that most people buy the wrong type of leverage at the wrong amounts with the wrong assumptions and with the wrong paperwork. So the second cliffhanger is not about whether insurance companies are greedy. It is about whether you bought what pays. And in many cases, the answer is no. How do you end up with coverage that never pays? One word: disclosure. In real life, when you apply for insurance, you fill out medical history questions. The company is building a probability profile. They are trying to estimate your future risk based on your past and present. That means if you underreport, you are not just being careful, you are changing the risk calculation. But the trap is subtle. People do not underreport because they want to commit fraud in a cartoon villain way. They underreport because they are scared, embarrassed, or exhausted. A lot of families avoid detailed medical conversations even with their closest relatives. So when the agent asks what feels like invasive questions, people freeze. They think, I have not been hospitalized, I have not died yet. So why does the form need every detail from the last 5 years? Then they give partial answers. Or they forget. Or they assume that a doctor's reassurance means the insurer must treat it as nothing. But insurance is not medicine. Hospitals judge your current condition. Insurance companies judge your risk trajectory. They do not only ask what happened, they ask what it suggests about what could happen next. Now, in 2026, with AI-assisted underwriting in many workflows and increasingly automated fraud detection, the chance of inconsistencies getting flagged is higher than it was when these processes were purely manual. Not because your insurer has a magic algorithm that knows everything, because your medical records, pharmacy claims, physician notes, and prior billing codes are more interconnected. The paper reality and system reality overlap more. Now imagine this scenario. You buy a policy while your life is stable, then you get sick. Not a dramatic movie-style illness, but something real, something that takes time, something that drains savings. You file a claim, and you discover that your coverage depends on a definition. That definition depends on documentation. That documentation depends on what was disclosed before the contract. And then you get the letter. We are going to delay this claim. We need more information. We have determined there is a material misrepresentation. Material misrepresentation is a phrase that sounds technical until you feel your bank account go cold. At that point, many people blame the agent. They say the agent filled it out wrong. They say the agent rushed them. They say the agent told them not to worry. But in court, verbal arguments are fragile. If you do not have clear written evidence that you were instructed to omit or that the agent told you a particular interpretation, your odds are worse. The burden of proof becomes your problem, not theirs. So who are the people most likely to sell you something and not want to emphasize honest disclosure? Not all agents, but the incentives are obvious. Agents are judged on closing contracts. In many systems, compensation can be reduced if applications fail underwriting. Agents can face chargebacks or clawbacks depending on the distributor structure. In plain language, if the process gets slow or complicated, the agent's income suffers. Pattern interrupt. Here is the part that should make you uneasy. In our economy, we keep telling people to be responsible consumers. We say read the contract, understand the fine print, ask questions. But when your life is already stretched, and when someone is selling you relief, you are not operating like a spreadsheet. You are operating like a frightened human being. Meanwhile, the same society that teaches you to read contracts keeps raising housing costs so high that many families have no buffer. In the United States, the United Kingdom, Canada, Australia, and across much of the developed world, housing has detached from wages. Renting is now a long-term lifestyle for people who used to dream of owning. That means when you buy insurance, it is not just a preference, it is one of your few remaining strategies for financial stability. So the moment the claim is delayed or denied, you do not simply lose insurance. You lose the plan that kept your household from becoming homeless. And that leads into the third escalation. The biggest reason people suffer is not just denial, it is that insurance often becomes a financial trap when the premium crowds out everything else. Now I want to talk about how policies can be engineered to look cheap while still being expensive in the only way that matters, cash flow. Some insurance products are structured with components that accumulate value. They can look attractive because they offer the promise that you can get your money back later or borrow against it. The pitch sounds like a hybrid of investing and protection, but from a business standpoint, if you are paying a large portion into long-term structures, you are also paying more over time, and more over time means higher costs and higher commissions. The agent likes these because the product can be easier to sell to people who are anxious about losing money. This is where the marketing gets under your skin. In the same way that social media sells passive income while the creator economy is collapsing for most people, insurance marketing can sell you peace of mind while quietly turning your protection into a savings vehicle that locks up cash. And you may think, why would that matter? Money can always be accessed, right? In practice, access can be limited, taxed, or penalized depending on contract terms and surrender schedules. And while you wait, your real life continues. Bills arrive, rent increases, car repairs cost more than you planned, healthcare costs rise, climate disruptions force families to move or pay for temporary relocation, and insurance markets can tighten in response to disasters. Insurance is supposed to protect you. But if the premium becomes a monthly drain, it can reduce your ability to absorb shocks. That is how a policy becomes another lever that magnifies your vulnerability. This is also the part where AI makes the story harsher. When your job is threatened, your income volatility increases. Your ability to keep paying premiums decreases, yet you still signed a contract with fixed premium obligations. So if your protection is not aligned with your actual income risk, you can do everything right on paper and still end up with a policy you cannot maintain or cannot claim effectively. Now, the Vietnamese transcript you are not hearing might sound philosophical, but I am going to keep it blunt and mechanical because people need clarity. There are four basic questions you must answer before buying anything, and they are not, do I like the agent? They are not, is this company famous? They are not, was I impressed with the pitch? The first question is, what is the premium you can sustain even if your income drops or if your hours are cut by automation? Second is, what event triggers payment? Third is the amount and how it is calculated. Fourth is whether the payout actually solves the specific problem you have, such as clearing debts, covering treatment, or replacing lost income. If you cannot answer those, you do not have protection, you have hope. Pattern interrupt. Ask yourself this question. In 2026, how many people have emergency funds? Many have less than 1 month of expenses saved. Many are paycheck to paycheck, even with two incomes. Many are trapped by high-interest debt from consumer finance and credit cards because rates stayed higher for longer. Now combine that reality with a policy you bought that requires you to be medically documented in a narrow way, or requires certain definitions of illness severity, or excludes pre-existing conditions unless there is a waiting period. That is why people buy insurance and still feel betrayed. They did not buy what they thought they bought. They bought a contract that pays under constraints, and they had to survive long enough to reach the constraints. And here is where the story gets truly ugly. Most of the time, when you hear a denial story, the denial is not the first warning. The warning is in the policy language that you did not read, or the agent did not emphasize, or the underwriting questions were rushed. So we are not dealing with randomness. We are dealing with predictable human behavior shaped by incentives. Now let's bring this down to something you can actually use. I will walk you through how I would structure protection like a business person who understands probability, leverage, and household balance sheets. I am not an insurance agent. I do not work for these companies. This is education, so you can evaluate your own options. But I want you to see the logic, because logic is how you escape being sold. Start with life coverage, not because you are obsessed with death, but because households depend on income. If you are the primary earner, the risk is not just losing your life. The risk is losing the stream that pays mortgages, car notes, education costs, and daily survival. Life coverage is essentially a way to convert a small recurring premium into a large lump sum under a specific trigger. If the payout is properly sized, it can replace income and prevent forced asset liquidation. In other words, it can stop you from having to sell the house to pay for the new reality. Now, sizing is not a vibe. It is a spreadsheet. You estimate your annual income. You estimate your debt. You estimate how long your family needs stability. A rule of thumb many professionals use is that the protection amount should cover multiple years of income. But in practice, the more important factor is the debt load. A household with high mortgage balances needs coverage that ensures the house does not become collateral damage when the earner is gone. If your policy payout does not exceed your debts and does not buy your family time, then your coverage becomes an emotional purchase, not a financial solution. And yes, cash in a bank account can help, but in disasters, cash can be tied up due to processing delays, legal administration, or simple chaos. Insurance coverage can provide a coordinated payout that arrives when liquidity matters most. That is the